Hello, today's video is about accounting. We will be covering the definition and importance of accounting, the accounting professions, basic accounting procedures, the balance sheet, income statement, statement of cash flows, the basics of analyzing financial statements, and trends in accounting. Let's get started. Accounting is how businesses track money, what comes in, what goes out, and what's left. Inside the company, managers use it to make smart choices. Outside the company, investors, banks, and the government use it to check if businesses are doing well. Accountants help businesses and individuals manage money, prepare financial statements, file taxes, and make smart financial decisions. There are two main types of accountants: certified public accountants and private accountants. Public accountants work for clients or companies and individuals. They've been certified by passing a special exam and must meet state requirements. Private accountants work with a single company to provide financial support like budgeting, tax support, auditing, financial consulting. Private accountants are not required to have a CPA, and they may have another certification, such as a certified managerial accountant or a certificate from a community college. Accounting helps businesses keep track of their money. At the heart of accounting is the accounting equation. Assets minus liabilities equals owner's equity. This equation shows what a business owns, assets, what it owes, liabilities, and what belongs to the owner, the equity. It must always stay balanced. The accounting process follows several steps. First, you must identify and analyze business financial transactions, then record them into the journal, post journal entries into the ledger, then prepare a trial balance to check for accuracy, adjust entries if needed, create financial statements like income statements and balance sheets, then close the books at the end of the accounting period. This process helps businesses understand how they're doing financially and make smart decisions. Over time, federal laws have passed to help improve this process. After major scandals, laws required companies to use strong internal controls, keep accurate records, and make top executives responsible for honest reporting. Now, accountants must not only follow the accounting process, but also follow legal rules, use technology tools, and make sure the numbers are trustworthy. Thanks to these laws, investors and the public can trust that financial statements are fair and accurate. A balance sheet is a snapshot of what a business owns and owes at one moment in time. It follows the accounting equation. Assets equal liabilities plus owner's equity. Assets are what the company owns, like cash, equipment, and trademarks. Liabilities are what the company owes, like bills and loans. And owner's equity is what is left after debts are paid. Assets are listed from most to least liquid. Liquidity is meaning that they can turn to cash quickly. Liabilities are listed by how soon they must be paid, and the balance sheet must always balance, just like a math equation. The income statement shows how much money a business made or lost over a period of time. It lists revenues, the money earned, expenses, the costs, and the final result, net profit or net loss. First, it subtracts the cost of goods sold, like ingredients and supplies, from sales to find the gross profit. Then it subtracts the operating expenses, like salaries, rent, and advertising. What's left is the profit before taxes. After taxes are subtracted, the business sees its net profit. This helps owners and investors understand how well the business is doing, and not just its sales, but its actual earnings. While the income statement shows profit or loss, the statement of cash flows shows how much actual cash a business brings in and spends. It tracks money moving out of the company and helps show how healthy the business really is. Cash flow is divided into three parts. First, the operating activities, such as cash, selling products or services. And second is the investing activities, so cash used to buy or sell equipment or property. Next is the financial activities, cash from borrowing and repaying money. This statement helps managers and investors see if the business has enough cash to grow, pay bills, or invest. Financial statements show how a business is doing. The balance sheet, income statement, and cash flow statement each tell part of a story. When used together, they give a full picture of the company's health. Ratio analysis helps compare numbers from these statements to see how a business is making profit or using resources wisely or has too much debt. There are four main types: liquidity, profitability, activity, and debt ratios. Managers, investors, and lenders use these ratios to make decisions. Just like a fitness checkup, ratios show if a company is strong, struggling, or needs improvement over time. The accounting world changed after new laws were created to prevent fraud. Accountants now follow stricter rules and focus more on auditing. Technology, especially cloud computing and automation, has made accounting faster and more accurate. Most businesses use cloud based software, so accountants need to understand these tools. Automation helps reduce manual work, making tasks like audits easier. As the job changes, firms need workers with tech skills who can also give business advice. Because switching firms is easier, accountants must offer strong, tech savvy service to keep clients and grow their business. That's it for today's video. Thank you for watching, and please subscribe to stay up to date with any new material. Have a great day.